Good morning, everyone. My name's Alex Barnes. I'm a sort of external audit partner at DMO. I'm sort of delighted to welcome you to the general insurance update. We've got a number of speakers this morning, so we aim to give it a sort of quick snapshot of key matters affecting the insurance market. So first of all, we've got Rob Murray. So first of all, we've got Rob Murray, who's head of Actuarial. He's going to run through key actuarial developments in the market, so in particular inflation, climate change, and other matters. We've then got Alison Barker, who's a sort of former senior member of the FMCA, who is going to sort of run through key regulatory matters. We've then got Thomas Toe from our tax side, who is going to run through key tax matters, which are particularly relevant given the change in government, and supported by Lauren Wilson, who's going to give you some key updates on our R&D tax credits and some good opportunities that insurers may be able to take advantage of as well. And then last but by no means least, we've got Geeta Joshi, who's an external audit partner who has joined us recently. She's got a wealth of insurance experience, and in particular, lots of experience on the particularly on the IFRS 17 side. And she's going to flag key challenges affecting the market on the IFRS 17 side, and also give a run through of what we're going to do as a firm to help keep you and colleagues in the frame of these key matters on that side. This session will be sort of recorded. Your lines will be muted. So if I could ask you to use the Q&A function to ask any questions, then at the end we'll sort of run through those questions. But without further ado, I'll pass you on to Rob Murray, who's going to give you the actuarial update.
Thank you very much, Alex. And I think the actuarial update is always a natural one to come first because it begins with an A. But thank you all very much for joining the webinar today. Given the amount of dynamism in the environment at the moment and the length of time of the webinar, we'll have a brief canter through some of the particular issues that we're seeing. Sorry, my video is not yet showing. There we go. So I won't be stopping to focus in lots and lots of detail, but as Alex mentioned, we'll be looking at two particular aspects. Inflation is clearly one of the hottest topics at the moment, so it would be remiss of me to not cover that. And of course, environmental matters of sustainability, and with a particular view on sustainability risks and the impacts for us as actuaries and insurers at the moment. So looking at inflation firstly, I've put there onwards and upwards, usually a very positive phrase, but in this case, it just seems to be where inflation is heading, although pleased to see with some of the recent news that perhaps there's a little bit of tempering, at least in the UK's expectations of where inflation might head, but it's still looking pretty grim, and I'm sure we're all feeling the pinch. I just wanted to talk about a few of the risks arising with regard to inflation. So I won't go into details of what's driving the inflation in much detail, but we can see that in many ways through global supply chains issues, energy cost crises, and the like. But looking at some particular risks, before I get into the actuarial, I just thought it's worth highlighting this risk of the valuation of assets, because it's one that could very well catch both insurers and policyholders out if not taken seriously. And I've just tried to put it together into a table to make some sense in terms of the implications of the undervaluation of assets, both for the underwriters and policyholders. So clearly, From an underwriter's perspective, if the values of the properties that you think you're insuring are understated, you might well carry the pricing risk there of underpricing that risk, and therefore clearly very important to make sure that policyholders understand the importance of declaring the value of their assets as accurately and as up to date as possible, and what the implications would be of underinsurance. There have already been a number of claims hitting the market where the actual repair costs have been far in excess of some of the valuations of the assets that were being insured. And of course, that can lead to a reduction in the claim settlement value, which the policyholder certainly doesn't want, and the underwriter would rather be able to support their clients and customer through their recovery and get the right price for the risk that they're bearing. So from the policyholder's point of view, that underinsurance risk is significant. It is important to maintain accurate valuations of those assets. We've certainly seen news stories this week of unusual valuations of assets, but I shall say no more at the moment on that. But getting it right is important. Obviously, I'm coming at this from an actuarial perspective, being BDO's head of actuarial partner, so looking on to the impacts and risks for reserving actuaries. Clearly, as we now continue through this increasingly intense inflationary environment, actually getting the reserve valuations right becomes more and more challenging, and the risk of misestimation of reserves can obviously not just have a negative impact on the insurance companies that we're working for, but also brings with it the professional risks of having given some advice in terms of the reserve valuations that may be found wanting. So it's important to think about this both professionally and in terms of getting the best understanding for our businesses as to just what the reserves are expected to be, but also what it may be under different scenarios and different inflationary outcomes. So in terms of some of the mitigations we're seeing from the actuarial reserving actuaries in this area, we're seeing increasingly explicit consideration and quantification of the impacts of inflation on reserves. And that can be quite complex because it can be different for different lines of business, different for different countries where risks are located. So it's important that those quantifications and considerations are appropriately considerate of the dynamics of the different economies and of the different lines of business. There are even some lines of business which are potentially exhibiting favourable outcomes as a result of inflation, which sounds unusual, but for example, things like motor gap insurance, where the amount that's being covered is the difference between either what was paid for the vehicle or the outstanding loan on a vehicle. Of course, with second-hand vehicle prices increasing significantly, that can actually have reducing effects on the average cost of those claims. So thinking through the impacts of inflation isn't just a one-way impact, but it does need some careful thought, consideration, assessment, judgment, and as far as possible, analysis of the data to try and see what are the emerging impacts of inflation, and also thinking through not just the impacts on the average cost of claims, but also on the frequency of claims. So there's going to be many different drivers of claim frequencies now as we go through more challenging economic times. People may be more incentivized to claim than ever before, given the pressures on them financially. Then again, we're coming out of COVID as well and seeing different behaviours in terms of things like vehicle usage, and we perhaps haven't returned to pre-COVID levels of exposure there as well. So it's a complex, difficult time to be assessing things, but being explicit of what we're thinking and seeing and trying to quantify that is important. So the next one I put there for the actuaries is that quantification and communication of both the sensitivity of results to key assumptions, but also going beyond that, the sort of the uncertainty around that. So providing some what ifs. What if inflation goes to X or Y? What do we think the impact will be on the reserves? Just to really help management boards actually have a fair view and a clear view of where the uncertainties and the judgments lie. We're increasingly seeing changes in reserving approaches. And those I've tried to sort of come up with some boxes to put them in. The first one, of course, is basis. So thinking about a different basis of projection. So we are now seeing some firms moving towards looking at projecting inflation-adjusted triangles to try and take inflation out of those figures and then put it back in explicitly afterwards. We're seeing some increasing move towards frequency severity analysis where the data supports it. And that's not just so that things like the average cost per claim can be more explicitly assessed, but that's so that the different features of frequency can be considered and understood as well. We're seeing changes in people's segmentations in some cases, and that may be looking at more granular heads of damage so that we can consider how inflation is going to affect, for example, repair costs in terms of the parts and the labour costs, or the loss adjustment fees, legal costs. Inflation is likely to have different impacts on all of those different things, so trying to get more granular to assess that is becoming increasingly common. We're also seeing particular focus on assumptions, so even where the basis or segmentation themselves may not be fundamentally changing, a lot more thought going into things like the loss ratios that are being used, both in the a priori methods and Bonnet-Ferguson methods, to make sure those are appropriately considerate of the effects that inflation will have. Did mention there that on the segmentation, seeing people looking at increased granularity of the accident periods. So, for example, moving from accident years to accident quarters, the thinking there being that if you're looking at the effects across a whole year's worth of incidents, that actually that might have some quite distorting effects, inflation, on the development curves that we're seeing. And if those can be broken up into more granular accident quarter or accident month segments, again, if supported by the data, then the effect on those individual development curves will likely be less extreme, perhaps just as the quantum of loss comes through, but the actual emergence of patterns stays relatively stable, is the thinking there. And I think key to all of this is that last point I've put here, that the more frequent and more detailed monitoring of the emerging experience. It's no longer just good enough to sort of say these are our expectations and that's it, we'll revisit next time we look at these. Many firms are putting in place more frequent monitoring so that they can assess the emerging experience, start to track and quantify the particular effects of inflation on their portfolio of risks and particular lines of business, and to validate or invalidate whether the assumptions that the reserve actuaries have been making with regards to the impacts of inflation are being borne out in practice or not, so that there's not just an early warning as to whether things are deviating from those expectations, but adjustments can then be made to come up with more frequent updates to the reserving estimates. So it's an interesting time to be a reserving actuary, to say the least, but then that's what keeps us excited and interested, isn't it? So that's my whirlwind on inflation. Just turning to sustainability risks, and I thought it would be worth here presenting to you the updates coming from the Solvency II regulations. For those of you working in EU insurance companies, these updated regulations, which came into effect last month, will already be factored into the work that you are doing in the UK, where we've Brexited, and therefore these regulations don't flow through into our regulatory requirements in quite the same way. This may be more of interest, but that's what I think it still is important, even for the UK actuaries amongst you, to understand these, because I think it's quite consistent, the changes that have been introduced to the Solvency II regulations with the Institute and Faculty of Actuaries statement on climate change and its initiatives to try and support and move to net zero. So even if these things are optional for you within your regulatory environment, you may want to consider introducing these considerations of sustainability risk into your work and looking at how Solvency II is expecting these things to be implemented. I think provides a good basis of what's going on in the market. So firstly, the delegated regulations have been updated to bring in the definitions of sustainability risk and sustainability factors. I've put them on the screen there. I won't go through all of these things in detail. Next, the updates bring in some particular expectations in terms of risk management policies. So any risk management policy that may be impacted by sustainability risks needs to be updated to reflect that. But in particular, the underwriting reserving policy now has to include actions to be taken to assess and manage the risk of loss or of adverse change in the value of insurance or reinsurance liabilities resulting from inadequate pricing and provisioning assumptions. So both the underwriting side of things and the reserving side of things there have to now take into consideration sustainability risks. Also, I've tried to make this fairly complete, this slide, in terms of the sustainability risk updates for the delegated regs. So I've also mentioned things like the investment risk management policy there also has to now include the actions to be taken to ensure that sustainability risks to the investment portfolio are identified, assessed and managed. The next updates were with regards to particular functions. So the risk management function now has to both identify and assess emerging risks and sustainability risks. These risks now have to also be included within the ORSA. And in terms of the actuarial function, in its opinion on the underwriting policy, it has to provide conclusions regarding consideration of the effects of sustainability risks. Next up, the remuneration policy now has to include information on how sustainability risks have been integrated into the risk management system. And then finally, the prudent person principle now introduces the need for sustainability risks to be taken into account in the investment risk assessments. So that's the range of updates made within the regulations in terms of sustainability risk. But I just then wanted to highlight three particular ones of relevance to the actuaries in the audience. So that clearly is that first one around making sure that the underwriting reserving policies are appropriately updated to include sustainability risks. I've also highlighted the ORSA there because the actuaries are, of course, required to contribute to risk management, in particular to the ORSA assessment. And the third one on there being the specific requirements of the actuarial function in regard to the underwriting policy. So there's three ways where actuaries are most certainly getting involved in explicit consideration now of sustainability risks. And if I just now look at some particular effects of climate change before I hand over, just to highlight some of the thinking that's the emerging experience and the thinking that's going into actuaries reserve work at the moment. Clearly, we've got the effects of climate change on property and business interruption insurances, and we have seen elevated levels of losses from natural catastrophes over the last 5 years. There was a relative dip briefly, but the last 5 years have taken things back up to a long-term trend. Now, of course, general insurance underwriters can sort of reprice the risks here on an annual basis. So that's one of the mitigations here have been able to sort of manage their way through the increasing exposures and risks from natural catastrophes. But also we see other things here, not sort of less of the catastrophic risk, but just the effects, for example, on household insurance and subsidence. This year we've had a particularly hot and dry summer. I saw some reports suggesting this is one of the worst droughts in the last 500 years. These things will drive subsidence claims. So it's not just the big sort of weather-related one-off events either. It's just the general environmental and climate changes here that are going to be driving insurance risks higher and higher. Next up, just in terms of some of the business risks, the sort of D&O risks and other liability insurances, the sort of general liability and environmental liability, we are seeing an increasing number of climate-related cases being brought. The figures I put on the slide there mention total number of cases now up to over 2,000, and about a quarter of those have been filed just between 2020 and 2022. So that's sort of can give you an idea of the increasing levels of litigation being taken in the area of climate change. A lot of that's against governments, but a lot of that is starting to really have an impact on companies as well, for many reasons. The sort of greenwashing, increasing disclosures with regards to ESG and the challenges that presents to boards to make sure those disclosures are accurate and appropriate. And then our third one I just put on there is the product liability risks, and that is an increasing risk as well. Many products that function relatively well within sort of typical and regular levels of temperature and heat and light, and through different seasons, are now being tested, in some cases quite significantly. The Allianz Global Corporate and Specialty quote that I've put on there, an excellent report they put forward. Definitely recommend going and have a look at that, but that gives some further examples. For example, the adhesives within windows on some trains are found to be not working and failing in increased UV light levels. So things that you wouldn't necessarily have even expected to emerge historically are now finding that they are no longer fit for purpose, and product liability claims are increasing as a result. So that's my whirlwind tour on both inflation and sustainability. I'd love to be able to talk more. Hopefully in the Q&A we can talk a little bit further, but I will now hand over to Alison to give us the regulatory outlook.
Hi everybody, thank you very much, Rob. So my name's Alison Barker. I'm a special advisor on regulation at BDO. I joined relatively recently, 6 months ago, and as Alex mentioned, I was a director at the FCA prior to joining BDO, with 12 years experience at the FCA, and prior to that I've got around another 20 years experience in financial services and regulation. So I'm going to carry on a bit of a theme actually from Rob, because the one theme, or the thing that is very much on the regulators' minds at the moment, is the rising rate of inflation and the cost of living crisis. So I'm going to be talking a little bit about that. I've got 3 topics which I'm going to cover in some depth, which is cost of living, consumer duty, and appointed representatives. And then 3 topics which I've sort of talked through because they're ones that you're perhaps more familiar with and have been working on for a while. Next slide, please, Ben. So cost of living. So as Rob mentioned, the economic environment is causing a lot of challenges for consumers. And whilst there's been a lot that the FCA has said in relation to lending activities, so consumer credit and sort of any secured lending, there are also impacts on insurance. And actually Rob touched on a number of those in the actuarial update. But I guess the key things are, the impact this has on consumers and small businesses, and the FCA's focus on particularly supporting consumers through this time. Financial pressures may lead to consumers becoming more vulnerable. There is a potential, I think there are already stats available which are showing increase in the levels of claims and complaints, and how that may need to sort of flow through into anticipating increased capacity for operational areas like claims handling or complaints handling areas, call centres having sufficient people to handle calls. And also then the impacts again that Rob mentioned, which were, as people try to make savings on insurance, ensuring that people are clear, policyholders are clear about the extent of cover and any exclusions or the application of excesses in the changing economic circumstances, and often as well thinking about whether there's any forbearance needed, or what happens if consumers are paying premiums late or are unable to pay them. Next slide, please, Rob. So I've sort of noted a few issues here that may resonate with you, but might be things that need to be thought through a little bit more. So insurance might not be the first thing to cancel. I mean, we've already heard, there's been a lot in the news about Netflix and other things like that, where people are cancelling subscriptions. But as budgets get squeezed, we could easily see much more of a squeeze on insurance and the payment of premiums. One thing to think about may be the increased level of fraud. So I was reading stats recently about the increased level of fraudulent claims that are already starting to come through. And one of the areas the FCA may be concerned about is that if there are increased barriers to consumers being able to make legitimate claims, and there's always a balance between the investigation of fraudulent claims or legitimate claims. As I mentioned, ensure that things are properly explained, cover and exclusions are properly explained, that clear and unambiguous terms. That's a theme that's come through from the interruption insurance, and particularly both in the commercial and retail world. Look at those. Insurers are already working through fair pricing practices, and we'll talk a little bit about that later, but the FCA will be scrutinising submissions, and we can expect further communication on those as we move forward. Some of the things to think about in terms of what to do, how are you planning ahead for consumers being able to pay easily? To manage forbearance on payments, what's the plan around that? Easier if you're the risk taker, not so easy if you're not the risk taker. Managing operational capacity, can claims be paid out more quickly without obviously causing challenges around fraudulent claims, ensuring the same level of scrutiny is applied. Ensuring that the customer journey, that any barriers to customers being able to complain or claim are properly monitored. We can talk a bit more about that under the consumer duty. And also monitoring the activities of intermediaries. So if small businesses are going to struggle over the current period, it may be that a bit more oversight of intermediaries is needed, particularly those who handle client money. In my past life at the FCA, sadly, there were examples of firms dipping into the client money pot when things got tough. So sort of making sure that sort of understand what's happening there is important. And then just a final one with consumers is whether there's any, whether it's something you would think about to signpost consumers who are struggling to debt advice services or other support services, whether that's part of your sort of consumer customer service type offering. Next slide. Thank you, Ben. So consumer duty is the next big topic, and they link quite closely together, cost of living and consumer duty. And this is one where BDO have, and we've been supporting a number of firms on the application of the consumer duty to their business, and also the planning. So we'll talk a bit more about the timescales in a minute. But I imagine a number of you are really quite heavily engaged and well on your way to delivering your plans for the October deadline for your boards. The consumer duty has been brought about by the FCA because there's over a number of years, there is still the feeling that firms are not delivering the right outcomes for consumers. That's the sort of background to it. And the FCA want to raise standards for consumers, but it's a very big piece of regulation and very sort of all-encompassing. It's quite complex in the insurance world because of the range of the length of distribution and supply chains, which are themselves quite complex. So there's quite a lot to think through. I put some topical points there, but some of the most topical areas for discussion that we're engaging with clients for the moment, there are still conversations on scope and impact. A lot of conversations about how to define good outcomes. and also how to measure consumer outcomes. Next slide, please, Ben. So for those of you who are perhaps not so familiar with the regulation, this just sets out the structure of the regulation. There's a principle for it applies to retail business or retail activities. There's a new principle that will be applied. So it's principle-based regulation with supporting cross-cutting rules. And the one that's interesting for me here, which is different, I think, to past areas such as TCF, is the avoiding foreseeable harm. That's quite complex in terms of being able to look ahead, particularly when we're in such uncertain times with a high inflation environment. You know, what might have been foreseeable harm in a low inflation environment is going to be different from what is foreseeable harm in a high inflation environment. And then there are 4 outcomes. So these stretch across 4 outcomes, which are the sort of basic areas of the consumer journey. Next slide, please, Ben. Timetable for those of you who perhaps not so closely involved in the planning. So the announcement by the FCA that plans had to go before boards for scrutiny by the end of October has caused a lot of scurrying around. Not all firms have a board timetable that fits quite so neatly into the FCA's October deadline. So, you know, we've been working with a number of firms in terms of what does the plan look like and perhaps providing feedback and challenge on plans. And it's fair to say that a number of firms, you know, are finding this quite a tough deadline to meet. For general insurers, there's also the April deadline. So manufacturers are to provide information to distributors by the end of April in order for distributors to meet the final date of the implementation date of the end of July. So that's potentially quite challenging in a general insurance world where you know, there's a lot of distributors to provide information to. Next slide, please, Ben. Oh, right, so I'm on my next topic. So consumer duty, I think, as we've noted then, is a very significant piece of regulatory change requiring a lot of work by firms to understand where they may need to make changes. Obviously, a lot of work's been done on the prod rules, but the next area where there's significant amount of change is around appointed representatives. And this also has quite a short delivery or implementation timetable from the FCA. The appointed representatives regime is also one that is quite significantly used in the insurance space. So in terms of the background as to why it was introduced, over the years, the appointed representatives regime has been around since the original Financial Services Act in 1988. But over time, the responsibilities of a principal to oversee the activities of the representatives has perhaps got a little bit lost along the way. And there have been new models that have arisen where, in a sense, you've got a principal who's paid to sort of host services on behalf of representatives. And it hasn't quite worked as the original intentions really required. So whilst it gives access to smaller firms to access the financial services market and to operate in that market, the oversight elements, which are meant to be there to ensure that representatives do what they're supposed to be doing, has not really worked. So the FCA has really upped the game in terms of how this regime will operate. And I've put in there the figures. So there are about 50,000 authorised firms and an additional 37,000 appointed representatives who are in fact supervised, and I shall use that word, by around about 3,500 principals. The deadline for implementation is the 8th of December, and it's going to have quite a significant impact on those firms who are principals. There's quite a lot of obligations that are being introduced. Next slide, please, Ben. So broadly, the requirements are around providing more information to the FCA, about the appointed representatives and what they do, and more information will be put on the register. So there are going to be reporting requirements, and some of those will come in over time in terms of the technology for the reporting, but the reporting requirements will start quite quickly. But the big one is what's expected of a principal, and a principal will be required to have quite a significant level of oversight of the appointed representatives, both of the regulated and unregulated business. And in the rationale for that is that the principal has to be satisfied that the appointed representative is fit and proper. And whilst they might be fit and proper on their regulated business, they could be doing things which would not be fit and would not mark them as fit and proper. So the FCA wants there to be much more scrutiny over what the appointed representative is meant to be doing. That also means then if there's more for a principal to do, the principal is going to have to think about whether they've got the capacity and the capability to monitor and supervise the appointed representatives that they have. And if just going back to the figures I mentioned earlier, I think it works out that on average, there are about 11 appointed representatives per principal when I did the maths. Now, clearly, there are going to be wide variances on that, but it could be quite a significant requirement to increase the ability to oversee appointed representatives. There is going to be an annual attestation required by the board and regular reporting to the FCA. The new requirements do cover introducer ARs, but it's a much less onerous requirement, and obviously they don't undertake so much work on behalf of the principal, but very basically there'll be notification requirements on appointment. Are they fit and proper, and has there been a scope agreed as to what it is they're meant to be doing? So these are three quite significant areas of change. So the focus on the cost of living crisis, the focus on the consumer duty, and the focus on appointed representatives are all quite significant pieces of legislative or regulatory change to address over the coming year. Next slide, please, Ben. Now, the next three areas are ones which may be more familiar and should be more, considerable work has been done over the last period, but I thought it was just worth updating on sort of a few things that BDO have been seeing. So firms would have been working very hard on operational resilience requirements. And just to note here, some of the things that BDO has noticed from the extensive work BDO has done in terms of helping firms or assessing where firms are. So, firms have conducted their walkthroughs, and there are some common areas that BDO has sort of advised on in terms of areas where, needs perhaps a little bit more attention. And then some feedback there from the PRA's initial assessment. So significant work done. There's some work still to do, but most of it is around, how do firms justify the judgments that they've made. Next one, Ben. So another area that has been one of, a great deal of focus over the last 9 months has been around GI pricing practices, and this links a little bit back to the consumer duty, because the amount of work that GI firms will have done in this space should put them in a good space in these particular areas under the consumer duty. So there's a few points there that have been that are noted. I think the next big deadline is for information to go to the FCA by the end of September, and as I mentioned, we would expect to see some feedback from that coming out after that period. Last area. So I'm not going to cover this in detail, and the slides are in the pack so you can have a look through, But just important to say, diversity and inclusion is a key area on the FCA's agenda. Requirements came out for firms in the summer that looked at listed firms and targets. So this is something you're probably all aware of, and I will allow you to have a look through the slides. And that is the end of the regulatory update. And I think I'm handing over to Thomas and Lauren.
Hi, good morning, everyone. I'm Thomas Toe. I'm an insurance tax partner at BDO. I've worked in the sector for 18 years now, working with insurers on a range of tax issues and tax opportunities. So today we'll just cover the emergency budget. I've got a lot of news which is hot off the press because the emergency budget has just concluded. So I'll share a bit of the confirmed tax changes anyway in a moment, and then I'll talk a little bit about the IFRS 17 adoption and HMRC consultation, and then finishing with R&D tax credits, where there may be opportunities for insurers with actuarial functions. So next slide, please, Ben. So Liz Truss, as we all know, is a new Conservative leader and Prime Minister, and it's well known that her brand of economics, Trussonomics, as has been labelled, is all about tax cuts and no windfall taxes. And boy, has she delivered that. I have been slightly distracted because I've been watching the budget that was delivered from 9:30 this morning by Kwasi Kwarteng, the Chancellor, and I can confirm, and this was where I prepared these slides anyway early this week, and I've been playing a game of tax bingo and just try to work out which of these possible changes have actually been announced. So I can confirm that the national insurance contribution, well, I was confirmed yesterday anyway, the increase from April this year will be reversed from November this year, which is fantastic news, obviously, for employers and employees. So lots more money in the pockets, businesses and people. The corporation tax rate, that's been confirmed. So corporation tax rate increase has been scrapped. So it was due to increase to 25% next April from 19%, but that's been confirmed that will be scrapped. And this will have implications for those of you who are preparing your accounts now, because you may have disclosure requirements, because this has been announced by the Chancellor. So do bear that in mind. So obviously that's no doubt great news for businesses, that the corporation tax rate will remain at 19%. Also, the basic rate of income tax, that's also been announced to come down from 20% to 19% from April next year. You might remember that Rishi Sunak had penciled that in for 2024. Well, that's been brought forward by 1 year, which again, good news for employees, no doubt. And the other, which was a surprise, I have to say, to me, is that the additional rate of income tax of 45%, that's being scrapped, that's being taken away. So from April next year, the highest rate of income tax will be 40%. So again, that's I'm sure that's again good news for for taxpayers. The other changes will be cuts of stamp duty, which I've got there as well. So they announced cuts of stamp duty with effect from today. And also the last couple of things have been confirmed today is that the IR35 rules, the off-payroll worker rules, which were introduced in 2017, those will be repealed. So it'd be interesting to see whether they'll be replaced with something else or just repealed in totality, which will make things a little bit simpler, I'd say, for businesses relying on contractors and agencies and so on. And then finally, I think you will also be pleased to hear, for those of you that are investing in your in assets, that the annual investment allowance, which gives you 100% allowance or tax relief on assets, was due to come down to £200,000 limit, but that's being kept at £1 million. So as you can hear, actually, there's lots of good news clearly for taxpayers, but I don't want to end this particular slide on a downer, but Kwasi Kwarteng also forecast that the energy support for the next 6 months from October will already cost £60 billion. So with all these tax cuts and the massive cost of this energy support, I do wonder, how is that all going to be paid for? I would also say that so far I've been checking online and I've not seen anything on IFRS 17 draft tax legislation. I was hoping that would come in, but I've not seen anything yet. But hopefully something soon will come in. And on that IFRS 17 point, if I could move to the next slide, please, Ben. Yes, I'll move on to IFRS 17 Adoption and HMRC consultation. I'm conscious of time, so I'll try to talk through this relatively quickly. So for those of you reporting IFRS, as you all know, IFRS 17 insurance contracts is coming in 1st of January 23, which is only a few months away. What happened earlier this year, HMRC did have a consultation to see how they can design the IFRS 17 tax legislation, and they asked for comments from industry and professional services and the like, and we certainly submitted a response to that back in February 2022, and the sort of things that we said in our response was to do with, well, actually the main thing is transitional adjustment. We know that for life insurers that will be very, very large, but I think the expectation is for general insurers, also the audience here, that they won't be as impacted. Although I do have a couple of clients who actually have pretty large adjustments. One has £100 million transitional adjustment expected. So what we said was that life definitely should spread that transitional adjustment for tax, spread it over 10 years, we said. But we also said actually for general insurers, yes, most general insurers won't be impacted by this, but we did say if the transitional adjustment is bigger or more than a threshold, then they should be able to spread it. And other things we talked about was looking at the accounting mismatches between cedants and reinsurers, because they could be accounted for in different ways, and therefore will there be an asymmetry in the taxation of the cedant and reinsurers. We talked about how this, what this all means for making tax digital, for corporation tax, and systems changes and digital reporting, and so on. And then OECD Pillar 2 as well, which is the global minimum tax rate being proposed globally. So we talked about the just thinking about the deferred tax when the UK designs its tax legislation. Next slide, please, Ben. So the outcome of that consultation was released in July of this year, and unfortunately they didn't listen to our suggestion of allowing general insurers to spread their transitional adjustment if it's of a certain amount or size. But what I can say is that they've confirmed that they will allow life insurers to spread their transitional adjustments over 10 years, which is great. And the transitional adjustment will be identified from statutory accounts by looking at retained earnings, so that's for the standard tax practice. And for the following tax, for following periods, will follow the tax rate will follow the accounts. So I'll quickly end there, but I would say actually for those of you who are on IFRS and therefore updating no doubt your systems to report this IFRS 17, there will be R&D tax opportunities as well. And on that, I will hand over to Lauren to talk about R&D.
Thank you, Thomas. So my name is Lauren Wilson. I'm a manager in the Financial Services R&D team here at BDO. We are quite a large team nationally of around 100 tax specialists and technical personnel that focus on R&D tax credits with different sector specialities. I have been specialising in R&D and patent box for coming up 6 years. I'm conscious of time, so I'm just here to give a whistle-stop tour of upcoming changes in the R&D tax credits regime. I'm sure many of you will have heard of R&D tax credits before, but for those that might not be aware, R&D tax credits are a great government incentive designed to reward companies for innovation. So for a company that is considered large, the net benefit is worth around 11% of qualifying expenditure and is accounted for above the line. For companies that are considered small, it's worth up to 33% of qualifying expenditure. Now, I've highlighted some projects on here that often people think are not eligible on the basis that they're not undertaking kind of blue sky research, but the R&D definition is far broader than many people think. For example, appreciable improvements to platforms where a lot of uncertainty exists can be considered qualifying. Moving to expenditure, the bulk of expenditure in a claim is often staff costs. So that's salary, bonus, employer's pension and national insurance contributions, and externally provided worker costs. But it is currently possible to include staff expenditure that is incurred overseas and recharged back to the UK. Say in a group scenario where overseas staff are supporting the UK with their R&D efforts. This is due to change for accounting periods beginning on or after the 1st of April 2023, when that category will no longer be considered a qualifying cost. It is also possible to include indirect staff who may not directly be working on the R&D. They can be included to the extent that they were supporting R&D staff, and software licenses to the extent that they were used within the R&D process. Now, as I mentioned a few moments ago, there are some quite big changes coming into the R&D regime from the 1st of April 2023. The draft legislation has been published that highlights some proposed amendments, and the first is the one that I just mentioned. The overseas staff will no longer be eligible, although there are some very minor exemptions to this. On the other hand, to support the growing volume of R&D underpinned by mathematical advances, the definition of R&D for tax purposes will be expanded by clarifying that pure mathematics is a qualifying activity. As you will know, the work often done by insurance companies is to find better ways to underwrite, spread and pool any respective risk, and that can require complex risk assessment, risk management and risk pooling exercises, which to date could not be included within R&D claims because such activities have been considered to be more of an advance in social science and not necessarily contributing to the generation of new scientific or technological knowledge. The definition of pure maths is yet to be announced, but if the inclusion of pure maths as an eligible activity leads to the reclassification of seeking actuarial science advances as an eligible activity, is likely to cause an increase in claims made while bringing actuaries into the scope of an R&D claim. The other big area is that the scope of software costs has also been expanded to allow data licenses and cloud computing. So that's data storage, operating systems, software platforms, and hardware facilities. And there is also going to be a bigger focus on tackling abuse of the system when it comes to validity of claims being submitted. HMRC recently hired an additional 100 inspectors in order to deliver more robust and consistent reviews of R&D submitted claims. And this tackling of abuse will be implemented in a few different ways. So all claims will need to be made digitally, and companies will need to notify of the intention of making a claim within 6 months from the end of the period to which the claim relates, unless that company has already claimed in one of the 3 preceding accounting periods. Claims will also require the endorsement of a named senior officer of the company, and they will need to include details of any advisory agent that was used as part of the preparation or submission. So this is where it really helps to use a regulated advisor who can provide HMRC with assurance. And finally, we do have an R&D benchmarking toolkit, which benchmarks and risk assesses your R&D tax credit claim against company of a similar size and industry. And we do offer a fresh pair of eyes over R&D claims. So to summarise, the changes are afoot in the R&D tax credit world that will impact the insurance sector. And it's a good time to assess your R&D tax credits position. And with that, I will hand over to Geeta.
Thanks, Lauren. Good morning, everyone. As Alex mentioned, I'm Geeta Joshi, and I have recently joined BDO. I'm insurance partner in BDO. Before joining BDO, I was a partner in EY. Today, I'll be covering a quick touch point on IFRS 17. So in terms of background, most of you would know IFRS 17 is effective from 1st Jan 2023. Some of you may be IFRS reporters, some of you are providing IFRS reporting to your group, and some of you may not be applying IFRS currently, but it may be something you may apply in future because UK GAAP may change at some point into an equivalent. So why is IFRS 17 such a big problem? why is it why is it taking so much time? The reason is the standard is really complex. There is lots of ambiguity, industry guidance and industry knowledge, industry practices are still evolving. It requires a massive change in data systems and processes, and let alone the complete revamp of the financial statements. To give you some examples, some insurers may have a small portion of their business that are contract with longer than a year duration, but you would still need to do PA eligibility test for that smaller portion because it will not automatically qualify for PAA approach, which is a simplified version. Now, to do the eligibility test, you would need some aspects of GMM incorporated into your system, which could be a challenge, as well as the standard says that your liability for remaining coverage and the two models should not be materially different. Now, materially different is not defined by the standard. What does that mean? It means that you would have to come up with a process and really engage with your auditors early enough so that, well, they can help and ensure that they're comfortable with the policy that you have created to say what is not materially different. Another main point I want to highlight is also on level of aggregation, which is quite key, as it influences how insurance contracts are grouped in terms of reporting and measurement, as well as it is used for PA eligibility assessment and also for reporting losses on onerous contracts. Now, contracts would need to be assigned to a group, and this assignment is quite complicated because you have to look at the risk of the contract. You have to see how they're managed, what are the expected profitability, what are the issuance dates. So it's really needs lots of data collection, analysis, estimates, applying judgments, changing the code processes, as well as creating an upgrade or a new system to ensure that you're tracking them at those levels. Another point I want to highlight is on defining contract boundaries. The contract boundary is something very key for level of aggregation and PAA eligibility assessment. Insurers will need to do a detailed review of their contracts to ensure that their assessment of cash flow within boundary or outside boundary of insurance contract is correctly applied. I mean, to give you an example, right, it is likely that a multi-year contract may turn into a short duration contract when you apply IFRS 17. And similarly, a short duration contract, maybe a single year contract, may turn into a longer duration contract just because of the terms in the contract. For example, it may have some mandatory renewal provision. So there are lots of complications involved when you start establishing these various requirements of IFRS 17. PAA, for example, is quite clear, which was a change made some time back, is PAA assumes no contract is onerous unless facts and circumstances exist, right? Now, facts and circumstances exist is an interpretation. It's not defined. So companies would have to come up with their interpretation, make sure they have a process in place to establish what are the triggers for facts and circumstances. And if that trigger exists, then they would have to do fulfillment cash flow calculations. So they need to have that tool also in place. There are other examples on issues, but just conscious of the timing, there are. I'll keep it short. There are issues with calculation of liquidity adjustments, identifying appropriate reference portfolios. Risk adjustment is something which needs to be explicitly valued. Some companies are leveraging on Solvency II, but we need to remember that Solvency II and IFRS 17, they are not similar. So there are complications involved in terms of how do you make changes from risk margin to risk adjustment. Profit emergence is quite different compared to IFRS 4. Your P&L looks different. So investor education would be very key, and engaging them early enough so that they understand the policy, as well as they can challenge management in terms of how the financials are coming out. So all these issues exist, and there are definitely companies who have gone beyond finalizing their policy, and they are into churning numbers, but there are a few companies who are still lagging behind. So what is the solution for this? What needs doing? I think at this point, my suggestion would be, don't put off your project too late. Definitely don't use your peaks and drops in your business as usual for doing IFRS 17 project, because it is really a challenging project, and because it's changing the whole remit of your finance function as well as actual function. Create your IFRS 17 team. Start engaging with your auditors early enough. Start engaging with your advisors if you don't have the respective skill sets within your team. Definitely leave enough time such that you leave some buffer for implementation, for your dry run, for creating this opening balance sheet, as well as doing comparative numbers. We at BDO are hosting webinar and roundtable meetings in November and early December, where we would cover these topics, and we also want to highlight and discuss views, industry perspective, developments in these areas. And so my final point would be, if you have any questions or you want to discuss any concerns on IFRS 17, you can reach out to me, or you can reach out to your contacts in BDO, and we'll take on from there. And thank you very much. I will now hand it back to Alex.
Thank you all for joining us this morning. And I'm sorry, we've slightly overrun. So we're going to answer the key questions that have come through directly with those who've asked those questions. This will be available later, so slides will be available with the recording later. Many thanks to all speakers, and it's really good to have a sort of tax update that was pretty live, to be honest, based on what's going on. So many thanks. Hope you sort of all have a very nice weekend.